Don Mazzella here again, and we have a really great guest, Chris Vanderzyden. I hope I pronounced it correctly, Chris. Um, she joins us, and I'm without further ado, I'm going to say, welcome to the show.
Thank you, Don. Happy to be here. Thanks for having me.
Well, first, as we always do, tell us a little bit about your background, and then about your company, and finally a website, and we'll go from there.
Sounds great. So yes, my name is Chris Vanderzyden. I am a partner with Legacy Partners, and we are an exit planning, mergers and acquisition advisory firm. And I started my career eons ago, it seems now, with PricewaterhouseCoopers as a CPA. Then I became an asset manager for a period of time out in Los Angeles. And then I started as an entrepreneur, ran a company for 18 years and sold it, and got involved in mergers and acquisitions. So I've been a mergers and acquisitions advisor for many years now. And so we guide privately held businesses in the middle market through that transition of exiting their business.
Okay, and do you have a website for people?
I do. You can find us at legacypartnersllp.com.
Okay.
Thank
Okay. I'll start my first question. We always say you never start a company without having an exit plan, but most people don't have an exit plan. So tell us, first off, what should an exit plan include?
Yeah, you're right about that, Don. According to the Business Enterprise Institute, 81% of business owners are planning on exiting their business in the next 10 years, thanks to the baby boomers that are now between the age of 77 and 58. And most of them, 80%, have no exit strategy. You're absolutely correct. And it's so critical. And I like that you said, you know, at the beginning, when you have this business, we all have business plans, well, we should have an exit plan too. And an exit plan is really just a comprehensive step-by-step guide that takes the business owner through that process of exiting their business. And we at Legacy Partners, and of course you heard that I wrote a book, Master Your Exit Plan. It's about how to sell a business. And we did that. I wrote that book because at Legacy Partners, we do what's called a master exit plan. And so it's not just the traditional exit plan, a long-term strategy of how you're going to transfer ownership from one owner to another. It really needs to be comprehensive. And so in order to do it successfully, an exit plan would align an owner's business, personal, and financial goals so that they can go on to that next chapter in their life successfully, you know, because as you know, business exits, they get close to that exit, they get nervous, and there's so many questions, right? How do I go through this process? Who will take it over? What will this mean to my financial future personally? What will I do next? These are all really important questions. And so a proper comprehensive exit strategy, it would address all of those questions and allow that business owner to make that transition really confident in what they're doing, how they're executing it, when they're executing it, what will become of their life next. So that's really what we consider to be an exit plan, is something that is very holistic and drives the whole process.
Well, you know, to me, the question is, well, we talk to so many people who are between the ages of 60 and 70, and their children don't want to have anything to do with the business. That we'll talk about a lot of things, but I want to make sure we got that one, because that to me is, you know, you're being handed the golden keys and you don't want it.
Yep. No, Don, you're nailing it right in the head. That's where we are today. I mean, when my mother grew up, they had a family business, and guess what? Back then, the kids, they worked in the family business. After school, they went to the family business. On Saturdays, they went to the family business. Nobody was out there playing soccer 7 days a week like they are today. So it's really changed. And so family successions, we don't see them anymore. And if the next generation has that golden key, as you said, handed to them, we end up being their next phone call. How do I get rid of this? Right. So, and it's unfortunate because, you know, that family legacy that the parents maybe have worked so hard for is going to have a different plan that's put into place. But family successions the success rate is very dismal these days. I mean, first to second generation we only are looking at, you know, God, right now you're looking at 78% failure rate. So, you know, that's giving us a 22% success rate, first to second generation. You move me to second to third, you're looking at a 12% success rate. And third to fourth, we've got 4% of people that survive. So whenever I meet a business owner that is a multi-generational family, the first thing I do is applaud them. I just met one that was a third generation. And, you know, I told him, I said, you're really part of the 12%. And he didn't really know that, but yeah, it's not a common exit strategy anymore, like it used to be. It was very common for privately held business owners years ago, but not so much anymore. And there's been there's famous ones. I mean, you know, Schwinn bicycle. Did you learn to ride a bike on a Schwinn bicycle, Don?
Of course.
Right? Didn't we all? Right?
Mm.
I was of the generation, I might be where we had the banana seat, right?
Oh,
The banana seat, right? Put the cards in the wheels, baseball
right.
cards, which now all the guys regret because, you know, the value of those cards went down the hill when we bent them in the wheels. But Schwinn is a famous case. I mean, you know, the fourth generation, Edward, he drove it into the ground, and he did it because he was using old philosophies, like he didn't want to use debt. So he was capital constrained. And then he didn't have appropriate leadership, and he didn't have a robust marketing plan. And now today you see it. How important is our marketing these days compared to decades ago when you could hang a sign out and do okay, right? But now we're global. It's a very noisy space. And with his marketing that was quite dismal, he allowed other brands to come in and steal his market share. And Schwinn died. I mean, this is 19th century, and they died on the fourth generation. And there's a million of those stories. But yeah, family successions are not as common.
Well, let me go to the other thing. You have these 25-year-olds and 30-year-olds who have a company, and all they can think about is their liquidity event. Either they prefer an IPO because they want to ring that bell at the stock exchange, and versus selling out to a larger company. But they don't think. No, let me say, what do you think?
About that as an exit strategy from the get-go? I applaud these guys. I guest lecture for Harvard University's entrepreneurship and innovation class. I've been doing it since 2014, so 8 years now, engaging with these students. They're in the MBA program, and you know, they're gung-ho, and you know, they've grown up with Bezos in the garage developing Amazon, right? I mean, they've had some serious entrepreneurs hit it big. So we have a lot of wealth in our country created by innovation, being an entrepreneur, bringing up a business. I mean, it used to be, you know, when I was a child, it was what we used to call old money, right? You inherited your wealth. Now they have really been shown that you can, with some innovation and a lot of sweat equity and hard work and a little bit of luck, you could become, they think, the next Jeff Bezos. Of course, going public, you and I both know you got to show a trajectory of growth that's pretty much vertical, right, to get that done. And very few are able to take a business public. But you're right, it's a big, sexy feather in their cap if they're able to do it and ring that bell. But it's hard to do.
Yes, but it is hard to do. But more importantly, I look at it as if they have no exit plan. For instance, they don't assume that they're going to fail. That's the part thing.
Right. No, no, they don't. And you're so right about that. We're always saying, people say, when do I start my exit plan? When should I do it?
When
And
you, the first day, in my
That's right. Don, you're spot on. As soon as you have your business plan, let's talk about the exit. And it's a living document. It's going to change. You may tell me you want to take it public, and then reality strikes one day and you realize maybe, you can't get there. You're not there. You're not positioned to go public. Not even a SPAC will take you on, right? And so, they have to exit some way. So they really have to get prepared. If it's not going to be a family succession, if you're not going to go public, if you're not big enough to do an ESOP or an MBO, most 80% are going to try to sell their business to a third party. And you're talking about the failure. And it's in the statistics are there. 80% of businesses that are brought to market fail to sell. They fail.
Before we go any further, the name of your book and where people can get it.
Thanks. It's Master Your Exit Plan. And it's about selling your business and preserving your legacy. It's on Amazon. It's all the big sites. And it went up on Amazon. It's already hit bestseller status in the business book. So that's kind of nice. But yeah, most easily accessible at Amazon. Yeah.
Okay. Well, now let's back up. And let's talk about that. I'm 64 years old, and I'm finally decided my son and daughter are not going to join me. What are some of the things I should be doing now in preparation? I figure I have a runway of 5 years.
Yeah. I mean, even if you haven't done it, you're right. Let's just get going today and let's start it as quickly as possible. If you give me a runway for 5 years, we're in good shape. So we start the master exit plan, and it all starts with doing a valuation of your company, because you've got to know what the value is if you're going to get out of it. Because if you don't know the value, first of all, if you go to sell it, you won't know if an offer comes in, if it's a good price or a bad price, unless you know the value. And also, when you do that valuation, that's the first step we undertake. You won't know if there's any weaknesses. And in every single company we do a valuation on, nobody's perfect. Everybody's going to have some weakness. And those weaknesses are exactly what keeps a business from attracting a buyer. That's why they fail, because they haven't uncovered those weaknesses, haven't shored them up before they go to market. So, doing a valuation, and then understanding what are those weaknesses and what can I do to optimize it. If you give me 5 years, we can understand the weaknesses and we shore them up. For example, when we take a business to market, what is an investor looking for? Well, number one, what do they want? They want to see a strong projected cash flow, because an investor is only going to buy your business if they see that they can get a return on investment, right? And here's a little glitch with business owners. They tend to focus on their past. They'll immediately start talking to me about their growth rates, how much revenue they're doing. They may know their EBITDA number, earnings before interest, taxes, depreciation, amortization. They may know that. And that's great. And I need to know what happened in your past, how you launched it, how you've grown, where you are today. But more importantly, we want to be forward leaning, and we want to know where can you go? What is the growth potential? Because a buyer, they want to get a return on investment. And the only way they can get it is in the future. Past matters, but it's really about the future. And business owners miss that every time. So we want to know that you have a strong future projected growth rate. So if you give me 5 years, we can work on that. We can work on a strategy that we can implement that will prove that out when you go to market. Or you may have weakness in your leadership team. Privately held business owners, sometimes they are a little too owner dependent. They don't have the depth in their leadership team, or they don't have strong employees. And you and I both know, look what's happening with our labor market. It's so tight. So we're seeing deals where businesses are buying businesses. They don't future projected cash flow, forget about it. Forget about customer, forget about it. Geographic region, forget about it. Now I want your employees, because that is the resource that we're needing today. So we're seeing deals we call aqua hiring. Company's going to buy another company just for the employees. It used to be, you see that a lot in tech industries, right? Looking for the computer engineers. We're seeing it in everything now. But, so if you don't have a strong leadership team or depth of employees, we can correct that over the next 5 years. Or maybe you've got too much customer concentration. An investor doesn't want to see that a large amount of your revenue is centered on just a few customers, and one of those customers leaves, gets swallowed up, gets purchased themselves, right? And you lose a big chunk of your revenue. That scares a business owner, and enough that, you can't sell your business. So you could work on diversifying your customer base or supply chain. Maybe your supply chain's weak. Right now we've seen, COVID really exposed that weakness in companies' operations. Do you have secure supply chains? Are they reliable? Are you diversified? Do you have a backup plan? Don't tell me you have one supplier. Please don't tell me. So, right? Please.
Well, let me interrupt you.
Yeah.
Most people don't have a 5-year runway. Most people have less than a 1 or 2 year.
Yeah.
So let's concentrate there, because that's
Yeah.
the majority of the people out there.
Yeah. Yeah. And we can make a lot of headway and prep a business to go to market, even in the short term. So for example, first thing you have to know, you have to have a valuation done. You have to understand what that valuation means to you personally. If I take that number and net it out for taxes and projected expenses to sell it, what is that going to mean to your personal wealth? So you understand, this is what it's going to look like. We can create an exit strategy that will meet your goals. And there's a lot of different types of ways to exit and sell a business, different structures. But we can take, for example, if you were 2-owner dependent and you want to get out in 2 years' time, or maybe you're going to give me a year, an average amount of time to sell a business, about 9 months right now. So maybe you want me to go to market right now. We can do that. And then what we tell the business owners, when it goes to the transition period, we're going to have maybe a longer transition. You're going to have to stay in the business, help the new owner, transfer those relationships over. Say the customers know you. We want to transfer that to the new buyer. So there are things that you can do to ensure that a business is successful selling, even if you don't have time. And it comes down to having, good advisory to help you through it. Yeah.
Well, what happens is people reach that point of selling. I know a story of the owner literally was driving to the sale and decided he just couldn't sell the company.
Yeah. That tells me he didn't have enough planning. He didn't have an advisor. We had a client once who was referred to as, he had a letter of intent. That's way down the road in the process of selling a company. He has a letter of intent. He talks to one of his financial advisors, and the financial advisor said, you got to talk to Legacy, because he said he couldn't sleep. I don't know if the letter of intent is good. He was working with one buyer, so probably not the best. It wasn't the best, right? And so what you're describing happens. I'm so fearful. I'm not going to close the deal. I don't know if it's the right deal. So they don't do anything. And then down the road, if they don't get help, the business just folds, and all that work that they did to build the business, the owner doesn't get any return on investment. It just circles the drain. It breaks my heart. Yeah.
Well, let's talk about valuation, because as you know, there are many different types of valuation.
Yes.
And no matter which one you use, the owner is going to say you're wrong.
So you are smart to point out that there's many types of valuations, because literally, owners of businesses don't even realize that. They don't realize that there are valuations used for legal purposes. Maybe you need a buy-sell agreement. And so maybe the insurance person is going to put together a valuation to base the insurance on, to fund the buy-sell agreement. Or you're going through a divorce, and now we've got to get a certified valuation to be used in court for legal purposes. But if you're going to market, what kind of valuation do you want? You want an M&A, a mergers and acquisition valuation, that's going to tell you what is the value of my business today if I'm going to market. so that I understand what a potential liquidity event means. And I also understand when I do get offers in the form of a letter of intent, I can judge them and say, what's a good offer or a bad offer? We always say our valuations that we produce, that number, I say to every single client, that number is the bare minimum you will ever accept, because your deal team, the quality of your deal team will drive the price and terms, and so will the market cycle. So that's the very least you want. So when we do our valuations, there's, what we do is we do the income methodology, which is discounting cash flow for future projected revenue. We also look at what's called CCM, comparable company market value. So looking out there and saying, okay, what other companies have sold that are like yours, not necessarily in an industry, but have a future projected revenue that looks like yours. What have they sold for? We look at what the private capital markets are saying, how much, what does that say? And then we do a broad-based, thorough mergers and acquisition marketplace. And our valuations have come in within 5% of deals. We're very close on our valuations. And then we drive it up.
Okay.
During the heat, yeah.
Your book again and how people can get it?
Yeah, Master Your Exit Plan, Selling Your Business, Preserve Your Legacy, and that's on Amazon.
Okay. Well, now, let me ask you a couple of questions. One is, there are a number of women who are now reaching the point of selling. But I heard a story the other day that seemed to say, again, like everything else, these women are not getting the same value for the companies that men are getting. Would you like to comment on that?
Can I just show you my face?
Mm.
Yeah, it shouldn't be happening.
But is it happening?
Yeah, and just like any man, woman, business owners, they get they lose value when they don't have an understanding of the process, and they don't understand M&A. And it's hard for business owners because, they're experts in their industry. They have worked in their businesses for years, sometimes decades. Their job is to know their business. Their job is not to know how to go through mergers and acquisitions. And what's happening is that we have such a great M&A market right now, with the cost of capital being very low, cash being plentiful. So that's getting deployed in M&A deals. The market is so active right now. You literally have buyers' representatives, private equity groups calling the business owners direct. And then they start engaging with the buyer directly. Right there, you're going to lose value. So it's just not realizing that you have to go through the process of selling your company correctly so that you don't run into these pitfalls, so that you're not taken advantage of. So I think that being taken advantage of is just a lack of information on who you need to help you and how to go through this process properly. And not taking that first, it's great to have somebody call you and say, I want to buy your business. But, I can't say this enough. One buyer is no buyer. And if you're engaging with one buyer, you're not going through the process properly, and you have a really good chance that I know 99.9% chance you'll be taken advantage of, and you will not receive full value, woman, man, either. Yeah.
Well, I guess I had a great question which went out of my mind. But I guess at this point, I'm sorry, I had a great question, but just went out of my mind.
I'm sure there'll be another one that'll bubble up.
One question: is it better to be stock, cash, or to have a payout over time? That's while I remember the other one.
Yeah, as far as terms are concerned, how you structure the deal is a big deal. So let's start with structure. I mean, should it be an asset sale or a stock sale? I just heard somebody yesterday who was telling me that an owner was closing their deal. They're working with the M&A attorneys, and the buyer, the deal was structured as a stock sale, which has a lower tax implication. So the proceeds are going to be taxed at capital gains. So they're at the end of this deal, Don, you wouldn't believe it. And they buried a change into the structure of the deal and put a 338H10 election in the small print in the documents. Well, a 338H10 treats the sale of the company as a stock sale for legal purposes, but for the IRS, it treats it as an asset purchase, which escalates the tax obligation from for the seller. And that was, I was shocked at that story because we've done a lot of M&A deals. We talk about structure up front. So the structure of the deal, asset sale, stock sale, how can we mitigate the tax impact? That's a big item. So we always say, value is analyzed, price is negotiated, but the terms matter. And so we'll say, you name the price, but we're going to name the terms because we know the terms matter so much. And cash, always king. Cash is always king. Burnouts, scary. Stock is risk.
Why bury that? What was the advantage to the buyer of doing that?
Of doing the 338, the change structure. So with that election and treating the sale as an asset sale, they're able to step up the basis in the assets and redepreciate. So good question, because you're right. The buyer is receiving a benefit, a tax benefit. So, I mean, I'm not saying we can get rid of a 338. We can get rid of that structure. I mean, we have negotiated it out. We just did one about 6 months ago, and we just computed the benefit to the buyer and said, no, it's not even a big enough benefit for you to argue on this with us. And they didn't, they let it go. But if we do have it, because if you do have an asset intense business, they are going to want to do a 338. There's no doubt it's to their advantage and they should want to do it. But if you have a good team, they're going to compute that benefit to the buyer, and we're going to ask to be compensated, our seller to be compensated for it.
Okay. Well, one more question. When do you tell your employees, and what do you tell your employees?
Yeah, good question. How do I break up with my employees? It's amazing how stressful this can be for business owners, but I get it. You built a business and you can't do it without your employees. They matter enormously, and business owners do feel obligated to reward them, and they're afraid to tell them. It's like it can go as a bad breakup, right? So we tell them, because of confidentiality, you don't want to tell them earlier than necessary. And most often we're going to recommend that the employees are told after the close, but very, very quickly. And it's part of the integration with the new owner. There's a whole strategy behind it as to when to tell them, how to tell them. I mean, literally, what do you say so that they understand and they're not scared? Because we need those employees to stay. They're very important. We also come up with plans. Some of the employees will know, what about the CFO or the controller that's helping us get through due diligence, right? So a lot of times we'll encourage the owner to give them a stay bonus. You're going to help us through this process of due diligence. On the other side, we're going to give you a bonus for helping us sell the company. And then there's non-qualified deferred comps which will help keep employees invested in staying with the company. But you have to do it at the right time, at the right pace, and saying the right words when you let them know. Yeah.
Well, Chris, your book again for our audience?
Master Your Exit Plan: Selling Your Business, Preserving Your Legacy.
Okay. Well, we've gone over our time, but 1 minute, what would you like to leave our audience with?
When you are getting ready to exit your business, before you're ready to exit your business, you need to be prepared. And so count on doing it in a comprehensive manner where you're aligning your business, personal, financial goals. That will guarantee that you have a higher success rate than what the statistics are out there. And if you need help, you can reach us at legacypartnersllp.com. My name is Chris Vanderzyden. I'm a managing partner here at the firm, and I'm more than happy to help you, or at least answer some questions if you need guidance.
Okay. On that note, we say thank you for a really interesting time.
Thanks, Don. A pleasure. Good to see you. That would be wonderful.
Oh, no, I